everyone. Welcome back to Finance Friday. It's another special edition of Money Girl, where I answer your burning money questions. I love hearing from you and want to answer your question. So if something finance related is on your mind, you've got a question about just, anything related to money, leave me a voicemail at 302-364-0308. You can leave your name or stay anonymous. Today's topic comes from Emily, who says, I'm a recent graduate in my first job and have to file my first tax return next year for 2025. Can you explain how to follow the tax rules without overpaying? Thank you for your question, Emily, and congratulations on landing your first job. I do think taxes can feel intimidating, especially when you start your career. So I'm really glad you asked this question. While the U.S. tax system is complex, you don't need to be a tax expert to file an accurate tax return. This podcast will review the basics of income taxes and how to comply with the law while minimizing the amount you owe. Your goal should be to pay precisely what you legally owe, but not a penny more. Welcome back, everyone. This is episode 971 of Money Girl. I really appreciate you downloading the show. I'm Laura Adams, an award-winning author, on-camera spokesperson, money speaker, and founder of The Money Stack. That's my Substack newsletter. You can learn more, ask any money question, and sign up for The Money Stack at lauradadams.com. You can get the newsletter for free or become a paid member with access to my live educational and Q&A events. While you might think that you only pay income taxes on or near April 15 every year, you actually pay them all year long. When you start working, you must complete Form W-4. That's the Employees Withholding Certificate. It tells your employer how much tax to withhold from each paycheck. And depending on where you live, you may also need to complete a state tax withholding form. If you receive a large tax refund every year, well, that means you overpaid taxes throughout the previous year and should adjust your withholding by revising your W-4 and any state form. A big tax refund means you let the government use your money throughout the year. It's kind of like giving them an interest-free loan. So it's better to receive a small tax refund or even have a small tax liability to pay to maximize your paychecks. That way, you'll have more to spend or save every month. If you're self-employed, you must pay quarterly estimated income taxes to ensure you stay on top of your tax liability throughout the year. And if you want to learn more about self-employment, you can check out my recent book called Money Smart Solopreneur, a personal finance system for freelancers, entrepreneurs, and side hustlers. It's available wherever books are sold. You've probably heard about income tax brackets. The U.S. tax system is progressive, so that means that not all your income is taxed at the same rate. A tax bracket is a range of income taxed at a specific rate, and each bracket has a progressively higher rate. So only a portion of your income is taxed at the highest rate. For 2025, there are 7 federal tax brackets: 10%, 12%, 22, 24, 32, 35, and 37%. If you're in the 24% tax bracket, let's say, your entire income is not subject to 24% tax. That's just the highest rate applied to your top range of income. For example, let's say you're a single taxpayer who made $100,000 in 2025. That amount of income puts you in the 22% tax bracket. But let's say your boss tells you that before the end of 2025, you're going to receive a $5,000 bonus, boosting your gross income to $105,000. But you realize that the cutoff between the 22% bracket and the next highest 24% bracket is $103,350. Should you worry about getting bumped from the 22% bracket into the 24% bracket? Absolutely not. You should be thrilled to get a raise because your income won't be taxed any differently, except for the amount that falls within the top 24% tax bracket. However, after subtracting the standard deduction, which I'll explain more about in a moment, here's how your federal income taxes break down by brackets for a taxable income of $89,250 in 2025. So again, taking that 105 and subtracting out the standard tax deduction, what happens is you're going to pay 10% tax on the first $11,925 of income. You'll pay 12% on the next $36,550, 22% on the remaining $40,775. So that gives you a total federal tax of $14,549. So that means your average tax rate is actually 13.86%. You get that by taking your tax, the $14,549, dividing by your gross income of $105,000. So my point here again is that brackets of your income get taxed at lower rates. So who has to pay federal income taxes? I think this is important to understand. Not everyone is required to pay income taxes. So let's review the legal requirements. Whether you must file a tax return is based on your gross income, your filing status, age, and whether someone else claims you as a dependent. Gross income is all income you receive that is not exempt from tax for some reason, and it typically includes wages, retirement benefits, and investments. It includes all sources of your income, including any earnings from outside of the United States. For 2025, you must file a tax return if your gross income is higher than the standard deduction for your filing status. And I'll go through what they are if you're under 65. If you're single, the standard deduction is $15,750. So that's the amount that I subtracted from the $105,000 of income in my previous example that created taxable income of $89,250. If you're married and filing taxes separately, the standard deduction is the same as single, $15,750. If you're married and you file a joint tax return, the standard deduction is $31,500. And if you're head of household, it's $23,625. And I'll explain more about deductions in a moment, but I want to note that you should always file as single if you're unmarried and have no dependents. But if you're unmarried and support a qualifying child or relative, you'll save money if you qualify to file as head of household. Now, if you're over 65 for 2025, the income thresholds to file taxes are slightly higher. That's because the standard deduction for those over 65 is slightly higher. And even if your gross income is lower than these thresholds, you still must file a 2025 tax return in certain situations, such as having self-employment net earnings of $400 or more, owing any special taxes, such as for distributions from a tax-advantaged account like an IRA or HSA, and receiving advanced premium tax credits for health insurance purchased through the health insurance marketplace. And I mentioned that if someone claims you as a dependent on their tax return, like your parents or maybe another relative, the rules are different. If you're a dependent, you must file a 2025 return if any of the following apply to you. Your unearned income, such as receiving interest or dividends, exceeds $1,350. Your earned income, such as wages from a job, exceeds $15,750. Or your gross income exceeds the larger of $1,350, or your earned income up to $15,300 plus $450. So I know that's a little confusing, but basically just remember that if you are a dependent, the rules are a little bit different. And it's important to understand that even if your income is below the filing threshold, you should still file a tax return if you had taxes withheld from your paycheck, or if you're eligible for a refundable tax credit. That's because you can only get money back from the federal or state government if you file a tax return. Now, let's talk about ways to reduce taxes. And I'm really glad that Emily is thinking about ways to avoid overpaying taxes. The best strategy for legitimately reducing taxes is maximizing potential tax deductions and credits. A tax deduction is an amount that the Internal Revenue Service, or IRS, allows you to subtract from your taxable income. And since a deduction reduces your taxable income, it reduces your tax. For example, if your taxable income is $100,000 and you have $10,000 in tax deductions, that reduces your taxable income down to $90,000. A tax credit is different. It is a dollar for dollar reduction in the amount of tax you owe, and that can be more valuable than a deduction. For example, if you owe $15,000 in federal income tax and have a $5,000 tax credit, that reduces your tax liability down to $10,000. Every year, you can choose between claiming a standard deduction or itemizing deductions. Itemizing is always wise when the total of your itemized deductions exceeds the standard deduction for your tax filing status, because that's going to cut your taxes. Itemizing allows you to add up specific expenses to reduce your taxable income. And unless Emily has a high amount of deductions, she's likely going to come out ahead by claiming the standard deduction because it's fairly high. However, Emily, I always recommend that you track potential tax deductions throughout the year so you can compare the total to the standard deduction, and then you get to choose the method that cuts your taxes the most. I recommend using a program like Quicken or QuickBooks if you have business income to categorize your expenses throughout the year. Then you can just run a report at tax time. While there are lots of deductions and credits to track, I'm going to go through a few of the most common tax deductions for 2025. There are state and local taxes, including real estate taxes, up to $40,000. There's also home mortgage interest and points paid on up to $750,000 of debt used to buy, build, or improve a primary or a secondary residence. And for mortgages taken out before December 15, 2017, there is a grandfathered debt limit of $1 million. You can also itemize medical and dental expenses that exceed 7.5% of your adjusted gross income. And charitable cash donations can be deducted for up to 60% of your adjusted gross income. Again, that's not a complete list by far, but just a few I think of the most common. But what if you don't have enough deductions to make itemizing pay off? Well, there are actually some deductions you can take even if you claim the standard deduction. For 2025, they include student loan interest up to $2,500 if you meet certain income limits. There's also traditional retirement account contributions. There are health savings account contributions and self-employment expenses. If you have business income, they include things like 1/2 the self-employment tax, contributions to a retirement plan, and health insurance payments. And some of the most valuable tax credits for 2025 include the Retirement Savings Contribution Credit. This is a non-refundable tax credit designed to help qualifying low to moderate income taxpayers offset the cost of saving for retirement. The credit amount depends on how much you contribute to a qualified retirement account, like an IRA or 401k, and your tax filing status. There's also some education credits, like the American Opportunity Tax Credit. That gives you a credit of up to $2,500 per year per student for qualified education expenses for the first 4 years of undergraduate higher education, and the credit amount is based on your income and tax filing status. There's also the Lifetime Learning Credit. This gives you a credit up to $2,000 per year for any educational expenses for an unlimited number of years. The credit amount is based on your income and tax filing status. And note that you cannot claim both the American Opportunity Tax Credit and the Lifetime Learning Credit for the same student in the same year. But you can choose the credit that would save you the most. So let's talk about how to file income taxes. Well, every January or February, you should receive various financial forms that will help you file your income taxes. These include Form W-2. This is a summary of earnings. It will come from your employer, including how much tax you've already paid throughout the year. If you're a student, you may get Form 1098-E. This shows how much interest you paid on any student loans. There's Form 1099-INT. This shows any interest earned on financial accounts like your checking and savings accounts. And you may get a Form 1099-MISC, which reports miscellaneous income such as freelance work. So once you have all your tax-related forms and information for various deductions and credits, you're ready to file your federal and any state income tax returns. If your income is below a certain threshold, you can file for free using the IRS portal, and I'll put a link to that in the show notes. You can also use tax software like TurboTax or hire a tax professional to complete your return. Be aware that the information I've covered in this podcast only scratches the surface of the U.S. tax code. So if you have any questions, don't hesitate to get help from a tax pro, like a certified public accountant or CPA. Their fee may be worthwhile to ensure you claim every possible tax deduction and credit to reduce your federal and any applicable state taxes. Emily, I hope this information takes some of the mystery out of filing your first tax return. I wish you all the best. And again, thank you so much for sending in the question. That's all for now. I'll talk to you soon. Until then, here's to living a richer life. Money Girl is a Quick and Dirty Tips podcast, and we've got a great team working on the show. Steve Rickyberg is our audio engineer. Holly Hutchins is our director of podcast. Morgan Christensen is our advertising operations specialist. Rebecca Sebastian is our marketing and publicity manager. And Nathaniel Hoops is our marketing contractor.